Philip Ingram, one of Platinum's investment analysts, will give an overview of both the global and domestic banking sectors. Philip, what is your framework for investing in the banking sector?
So when we look at banks, just as anything else, there are no hard and fast rules, and we have to be flexible in our thinking. Having said that, we have a very simple framework for analysing banks. So we think about the type of bank, we think about its competitive advantages, and we think about the economic cycle. Broadly speaking, there are investment banks, there are government-influenced or controlled banks, there are banks that deal with large corporates, and there are universal banks. At Platinum, we tend to invest mostly in universal banks. When we say universal bank, what we mean is a bank that operates throughout the economy, deals with small businesses, large businesses, households, and local governments. The reason we tend to invest more in these banks is because the other banks have risks on their balance sheets which are much harder to analyse and assess. And with universal banks, you also have a sustainable, relatively low-cost funding base. You have millions of depositors throughout the economy. That brings me to the second part of our framework for investing in banks, which is the sustainable competitive advantages of those banks. So the core of our philosophy is that most of the value of a bank is created on the liability side of the balance sheet, on the deposit side. You or I can lend money today. We can go onto a peer-to-peer lending platform and do it. It's very easy. But what we can't do is take deposits. To take deposits, we need a license from the government. So it follows that most of the legal and economic value of a bank is on the deposit or funding side of the balance sheet. Now, when it comes to those deposits, a bank could stick a sign in its window offering a very high rate, and it would get lots of deposits. But the bank we want to invest in is the one that pays its depositors little or nothing for those deposits, and it's able to do that because it's built relationships with them and it offers a customer service. So for us, that's the most important competitive advantage for a bank. We also think about the IT infrastructure of the bank and the management. So when it comes to IT and infrastructure, if we think about what it might be like walking into a bank that has very good IT and infrastructure, so you'd be sitting opposite someone who would have all of the details about all of the products you and your spouse might have with that bank. If you've lost your bank card and you're going on holiday tomorrow, you won't have to wait 10 days for the card and then the PIN to arrive. Within 5 minutes, they'll print it within the bank branch. Or if you want to send your money to a family abroad, there's no 3 p.m. cutoff because it's instant, straight-through processing for all transactions. The other thing we think about in terms of competitive advantages is market position. So is it a small challenger bank with a tiny market share that can grow, or is it a big bank like the Australian banks with a very strong position and pricing power? And finally, the third part of our framework for analysing banks is the economy, and this is where we spend most of our time. Essentially what we're trying to do is gauge whether bad debts are going up or down and whether banks' balance sheets or loans are going to grow or contract. So to summarise, we tend to invest in banks that are universal banks, that have a good core deposit franchise, have a sustainable low cost of funds, good IT infrastructure and management, and a strong market position. And we'd like to invest when bad debts are starting to fall and loans are starting to grow.
And then how would this apply to the Australian banking sector?
If we think about Australian banks, they've been almost perfection for the last quarter of a century. They've been the antithesis of what we've seen in banking markets elsewhere in the world, where there have been lots of bad debts, there have been banking crises, and there have been lending crises. But the time to invest in Australian banks was when they last had a crisis. So for context, if we think about what it must have been like to invest in Westpac, which is one of the 4 big Australian banks, in 1992. So back then, Westpac had just announced a $1.6 billion loss. It had cut its dividend. It was firing 15,000 staff. It was closing branches. And when it tried to do a rights issue to raise more capital, 3/4 of shareholders rejected the deal. And the bottom only came at the end of '92 when Kerry Packer bought 10% of Westpac at $2.50 a share, or for $500 million. If he'd held that stake today, it'd be worth more than $10 billion. So the time back then when Kerry Packer was buying Westpac, the Australian banks were only trading on 6 times profits. Today they trade on 15 times. Now, the reason the Australian banks have performed so well subsequently is the bad debt charge has dropped from 2.5% to 0.1%, and household debt to GDP has grown from 40% to closer to 140%, which is amongst the highest in the world. Now, what we try to do at Platinum is to invest in banks that are like Westpac in '92, not like Westpac in 2016. And we find many opportunities and examples like this around the world today.
So what global banks do you find interesting?
So using our framework for analysing banks, today we can find many prospective banks to invest in around the world. For example, we have positions in several small Indian banks. Now, India is an interesting market because 3/4 of that market is dominated or controlled by government banks. These tend to offer a poor customer service, and their balance sheets are encumbered by large amounts of bad loans. This gives an opportunity for the small Indian banks that offer better customer service to take share. Also, debt to GDP in India hasn't moved for more than half a decade. It's one of the few countries in the world where this is the case. So there's a lot of room to grow. In India, of course, there are also a large unbanked population. In the UK, it's another highly concentrated banking market. Because so many banks went bust or were nationalised or acquired in the GFC, you're left with the 5 largest banks controlling close to 90% of the current account base. Some of the small banks which have launched in the UK over the last 5 to 7 years have an interesting customer service proposition and are growing very quickly, and we find opportunities there. We have 3 positions in Eastern Europe. Now, Eastern Europe has had a torrid time for the last decade. It's had a severe crisis during the GFC, and that's been followed by political crises, banking crises, and currency crises. But during these processes, most of the bad debts in these economies has been written off, and at the same time, the Western European banks that rushed in before the crisis have exited. So you're now left with a situation where the banks that don't have much leverage, households and corporates don't have much leverage, and the economies in these countries are starting to rebound strongly just at the same time as competition has left. So in summary, while one could invest in the Australian banks, we find many more attractively valued and prospective ideas elsewhere in the world.
Thank you, Philip. For the latest commentary on global markets, please visit the journal page of our website.